Hello, and welcome to another edition of Ballast Book Talk. Very excited and honored today to have Mark Hebner on with me. He's the author of Index Funds, the 12-step recovery program for active investors. Mark, welcome to the show.
Thank you, Andy. It's a pleasure to be here and an honor.
Good, good. Well, I like to talk a little bit about kind of your background, where you grew up, how you got into this, and how you became an expert in this field. So maybe you could start there.
All right. Well, my early career was in a completely different field. I'm actually a nuclear pharmacist by my college education. and I was born in Manistee, Michigan, way up northern Michigan. And we moved out to Santa Barbara and then lived in Las Vegas for a while. Actually, went to high school in Las Vegas and then moved over to New Mexico, went to college there at the University of New Mexico and studied nuclear pharmacy. From there, I met a partner.
What exactly is nuclear pharmacy?
So, in the nuclear medicine department of a hospital or a clinic, it's a section of the radiology department. They do nuclear medicine studies, and these are uh, done by injecting radioactive pharmaceuticals into patients that emit radiation, as opposed to an X ray where they send radiation through you. And so someone has to prepare these drugs, or basically tagging a radioactive substance to a pharmaceutical and then deliver it to the hospitals and clinics. So my partner and I started a company back in 75 and ended up in 45 cities around the country. And 10 years later, we sold that. And so at the ripe old age of 32, I was retired with lots of money. We took the company public and trying to figure out what to do with my life. I looked at all kinds of different business opportunities, but many years later, 12, 15 years later, a friend of mine was killed in a car wreck. And the widow got around a couple of years after that asking me for help with her investments because she thought, since I was a business person, who ran companies and in the public markets, I would understand how investing worked. As it turned out, I didn't have a clue how an investing worked, but because of my desire to help her and my own desire to learn what was going on at my own portfolio at a brokerage firm that I had arrived at with my money, I thought this is a great opportunity for me to take some time and really figure out what's going on in markets. And so that loss of her husband led to this opportunity for me to figure this out for myself, first of all. And today, we're over $5 billion of clients that we're helping. And we basically took the lessons I learned and put those in a book, put those in a film, put those on our website so that prospective investors with us could learn in advance what we were trying to educate them on without us having to do some kind of sales pitch. They could learn at their own pace, if you will.
Right. Okay. So, what did you learn when you looked at your portfolio and you looked at your friend's widow's portfolio? What did you learn? What surprised you?
Yeah, it was actually shocking what I learned. What I learned that was so critical is that this entire industry, almost 99% of the investment industry, is based on this idea that there are either undervalued or overvalued securities in the market. And when they're overvalued, your mind says, oh, I should get out of those because they're going to come down at a faster rate than maybe the overall market. People don't really even think about the relativeness of over or undervalued. And if they're undervalued, boy, I should be scooping those up because somehow the tens of millions of people who are trading today didn't quite see what I saw. Okay. I see there's an opportunity, but other people somehow didn't see this. Okay. And so there is this ongoing pursuit to try to do better than what we call the market return. Let's just call it the S&P 500. And almost everybody's goal in this industry is, oh, I don't want to just accept the market return. I can shoot the lights out and do way better than that. What I learned is that managers were not beating markets, markets were beating them, and by a huge margin. And the reason is rather than uh, uh, having securities over or undervalued, they are all fairly valued. There are no under or overvalued securities. And that's because we have these equal and opposite forces of 10 million people, half of them buyers, half of them sellers, bringing all of their knowledge, information, and forecasts to this, what we call splendid exchange. And through this process of the buyer not wanting to pay too much, the seller not wanting to sell for too little, we arrive at a near perfect price, or what's really what an academic calls a fair price at all times. And that now destroys the whole concept of people reading the news or looking into the future and saying, oh, I better move this, I better move that, because the prices have already adjusted to that information. And the idea that you have some knowledge that is not already known by the market, or that you have some better forecasting ability than the combined forecasts of 10 million people is absurd.
So what is the solution? And I know that you spent 10 editions of index funds writing this in your 12 steps. So
Right.
as much as you can quickly surmise it here, what is the solution? And talk about active versus passive investing and how people really should be
Sure.
looking at it.
So, as short as I can say it, what people are doing is they're hoping to earn returns as the result of their speculation about what's going to happen. But that's not what markets do. Markets price investments so that investors are compensated for the risk they take. It's almost the opposite of the active investor. The active investor wants to avoid the risk and get the return. Oh, markets are going down next year. I'm going to cash. Okay. That's avoiding the risk. But the fact of the matter is returns are risk compensation. So it is a reversing of the thinking about what markets and what investing is all about. And that is owning an appropriate exposure to risk across the whole world. And there's lots of different ways for you to have this exposure to risk, and owning that, and then holding it, and basically collecting the rents, the interest, just like a bank collects the interest from you. What it really is collecting the cost of capital of the seller. You got to think about that one a little bit. But imagine you're wanting a mortgage on your house, and you have bad credit. You go to Wells Fargo to get a new mortgage, and they look at your credit score. They say, "Oh man, your cost of capital, what you're going to pay on your mortgage, is going to be really high because your risk is really high." Okay, that is exactly what's going on when securities are priced in markets. They are priced for their risk. And in equities, they're priced at a level that provides the expected return that's appropriate for that risk. In bonds, just like in a mortgage, it's more clear. The bond says, I'm Nordstrom, and it's the we're right in the middle of COVID, and nobody's coming to Nordstrom's, but I need money. So I'm going to issue bonds. The market's going, are you kidding me? The risk of owning Nordstrom's in COVID is tremendous. You better pay me about 12% a year. Whoa. And Nordstrom says, wait a minute, that's a high cost of capital for us. But then they realize they're risky, they need the money, and they issue the debt.
And the market sets that. It's a fair market price. The market sets it.
The market sets the price because Nordstrom says, all right, I need the money. I'm willing to do it at that rate. And the market says, you're risky, but that's a return that I think is appropriate for my risk. Therefore, we will trade. That's for debt. Same thing for equities. I like to say my extreme risky equity is the publicly traded dry cleaner in Thailand. And they fly to New York and meet with the Goldman Sachs folks, and they say, gee, we'd really like to sell our shares here in the US. We'd like to do an IPO. They're not going to do that from Thailand, but just as an example. And the guys at Goldman Sachs, the investment bankers, are rolling out of their chair laughing. Who is going to buy this publicly traded dry cleaner in Thailand? But the guy says, I really need money. And so now Goldman says, okay, well, maybe there's an opportunity here. If we push the price down enough, we force the dry cleaner to have a high cost of capital. We actually might attract a certain risk capacity investor, a high risk capacity investor, to actually put money in there with the expectation of earning maybe 14 or 15% return on their capital. Because that is the cost of capital for a risky equity issuer.
Yeah. And if it's Coca-Cola sitting in that room,
what's that?
If it's Coca-Cola sitting in that room wanting an investment from Goldman, then it's obviously going to be a much different scenario. It's less risk. The cost of capital is a lot
lower. So what do we see? Your precise point, when we look at S&P 500 companies, over the long haul, their cost of capital has been about 9.5% a year. But if that publicly traded dry cleaner from Thailand wants money, they better get ready to have a cost of capital in the 15 or 16% range, not 9.5%. And that is what is going on in markets. And it is a complete reversal from the line of thought that says, Tesla, that looks really interesting. They got all these great products. Elon Musk's a genius. I want to own that stock. And nobody says, I wonder if all that information is already in the price. And then you go, okay, if it's already in the price, now what kind of expected return is there? As it turns out, it's not that great because we've already have all these high hopes and really low cost of capital for Elon and for his companies because they look so wonderful compared to his competitors.
How different is your I guess you could say philosophy or your outlook or your investment strategy compared to your average financial advisor on the street, who they seem to want to do maybe not day trading, but they want to churn, they want to change up the portfolios? How different is the way you and your firm operates?
So, like so many people say, you want to follow the money. Okay. What you want to look at is, how does this person who's trying to get me to engage with them make money? So, as you say, there's most of this industry who wants to get you to trade. Well, the reason is their compensation is tied to trading. The business model of almost all of the companies in the investing industry is to make money on transactions, not to collect a percentage fee on the total assets they manage. That is a also completely two different approaches, if you will, to the customer experience. On one hand, the broker is is forced into a position to constantly get you riled up about what might be coming in the future. And if the future looks great, oh my gosh, you should load up and buy more of these equities. A couple of weeks later, some news comes out. Oh, wait a minute, that's not so good. Now I think you should sell those. And what happens? Well, the guy's got a Mercedes car payment. He just met his payment by getting you to do two different trades. If someone is collecting a small percentage, let's call it 0.5%, just to throw a number out, and they get that whether or not you trade, their motivations now have reversed. Their motivations are to do what is the best thing for you and to get your capital to grow, because as your capital grows, their percentage grows. So you bring up a really good contrast, because the brokerage world is regulated also by what's called FINRA, and they do not have what we call a fiduciary duty to their client. The fiduciary duty states you must do what's in the best interest of the client, regardless of whether it goes against your interest. That is not as what's going on in the brokerage industry. But the registered investment advisor has a different set of rules. They're governed by the Securities Exchange Commission, and they are required to be a fiduciary for their clients. How many clients that have their money at brokerage firms understand this? Zero. It's buried in the client agreement, and people don't understand that they are not required. They have what we call a suitability standard, that investments are suitable, but they're not a fiduciary standard, which is, I don't know, I want to say infinitely, but it is substantially higher level of what I'll call customer care. And so that's really important, because who do you think knows more about how markets work, the client or the provider of advice? Okay.
Better be the provider.
And what makes a broker good is how they can tell a story about what you should be doing. They're making up literally fairy tales about how you should move your money around based on their vision of the future, and how eloquent they can be at describing those visions. And that's why they end up on CNBC, by the way, is what drives the income they can make from you.
So those stories, we see CNBC and we see, Kramer yelling at the TV, and it's very entertaining, right? But the point of investing is not to be entertained; it's to create lasting wealth. So, is that one of the reasons why this book isn't, your book Index Funds? This isn't a glamorous story of crazy trades, and it's very conservative, right? Is that your reason for writing? Now, still entertaining with, we'll show the beautiful color interior and paintings inside with your 12 steps.
Yeah.
To investing. Is that the reason that you initially wrote the first book?
Yeah. So what happened is I made this career change, Andy. I was, a nuclear pharmacist. And all of a sudden I said, okay, I think I'm going to be an investment advisor. And people are going, what the heck do you know about this?
And what year is this? This is
1998. Okay.
So 25 years.
Yeah. Well, it's more than, 1995. It was March 5th of 1999 that I opened the firm, but I started my research in 98. Okay. And so to gain credibility, I needed to demonstrate my knowledge to people. And originally, when I wrote the book on this, it was that big. What we have today is the mini version of this. And this was written as a textbook. And if you want credibility, write a textbook. That's what I did. But I couldn't get anybody to read the textbook. So I had to write a summarized book. And ultimately, even that is sometimes difficult. That's why we have audiobooks today, and why I created a documentary film that summarizes this. And we're in the process of updating the film we did, I don't know, 5-6 years ago to the new information in the book. But I wanted to hit on a point because you said the word entertaining, okay? Las Vegas and gambling is entertaining. And that is part of what's going on here. And how I ended up with this 12-step recovery program, because way in the corner of the casino in Las Vegas on the way to the restroom is a little brass plaque that says, have a gambling problem? Call Gamblers Anonymous. It's a requirement, I think, by the Nevada Gaming Commission that you provide this opportunity for the drunken broke gambler headed to the restroom either to throw up or relieve themselves. They have some notification that maybe they should get a check on their emotions on this gambling. As it turns out, as I did my research, what I realized is that people are literally just gambling in the market. And I Yahooed, there was no Google in 1998, I Yahooed gambling in the market. And I ended up on the New Jersey Alcoholics Anonymous website, where there was a tab on the side that said, Gamblers Anonymous for stock market gamblers. I said, what? And so they actually have a program that deals with stock gambling at Gamblers Anonymous. And that is where I got the idea to use the framework of a 12-step program, which is lightly like Gamblers Anonymous, but to use that as an educational framework to get people away from this speculated gambling. And instead, to use the casino analogy, to move from being the gambler in the casino to being the casino.
Yeah. You want to be the house.
You want to be the house. So what does the house do?
It teaches you to be the house.
The house is basically buying an index fund. They own all of the games and they play all of the time. Playing all the time is like holding, and buying all of the games is like buying the index. We're buying every security there is in the planet. Typically, when we've designed these index portfolios, there's 13,000 companies from, 40 different markets, exchanges, stock exchanges around the world. 13,000. So we're playing every game on every bet in the house. And we're also buying all of the debt. We're buying about 1,000 different bonds. And so now what you've done is you've diversified away the specific risks of any one company, of any one day, of any one industry, of any one CEO, and you have reduced your risk of one of those bets going bad. And instead, you've backed up and said, I want to collect the cost of capital of a blend of indexes that might have a tilt, a little more small companies, those Thailand, dry cleaners, and a little more value companies that are kind of cheap, low, or priced kind of low, because the academic research says those companies have higher costs of capital, and you should own some of those. It's kind of like the bank saying, maybe we'll have 10% of our loans and mortgages in subprime market.
Yeah,
right?
diversifying, because in
You're
the end,
diversifying.
take it across the whole spectrum. The house is always going to win.
Exactly. And so think about it. As the casino sits there and sees somebody winning big at the blackjack table, do you think they well, they might be card counting, but assuming they're not card counting, okay. The equivalent of that in the market, by the way, is insider trading. All right. But assuming they're not card counting, they say just let them play because eventually the odds are in our favor. And this is one of the unusual things that I put together in the book is oops, I grabbed the wrong book. That was the old one. In chapter 8, I explain that investing is really just about the odds. It's a bell curve of future outcomes. And you can literally take 50 years of historical returns of a certain blend of indexes and get an estimate of what the monthly average is and the range of returns around that average, and end up getting a bell curve that, show you here, you end up getting a bell curve that shows you the probability of getting different returns. So there's about a 20% chance that this portfolio the monthly return will land in the middle that has a return for this particular portfolio between 0.2 and 1.2. Okay? 20% chance on a monthly basis, that's where you'll land. That's what the casino does. Now, why does it make it analogous to the casino? Well, the casino is relying on a fair dice, a fair spin of the wheel, a fair dealing of the deck. Okay? So you're always starting out from the same probability if it's fair.
Yep.
What happens?
52 cards, six sides to a die. You know the math. However many on the roulette wheel, they know the math.
So it's what we call fair. Okay, fair is a statistical term. In the markets, how do we get to fair? We start with the fair price, and we arrive at that fair price by the best way that humans have come up with, which is allowing the intelligence, not the artificial, but the human intelligence of two individuals, at least, but we have 10 million a day, to agree on a price in a equal and opposite position. I want to sell, you want to buy. Let's bring our knowledge and information to that exchange and do this 10 billion shares a day with 10 million people, and you've squeezed out all the mistakes that somebody might make, two people might make, and you arrive at the fair price. So today, a lot of people are saying, oh gosh, 2024 is making me a little bit nervous. I think I'm going to go to cash, right? Well, wait a minute. Don't you think?
Can't time the market.
Don't you think that's already in the price? This is what people have the most difficulty wrapping their head around, is that the price already includes what you have forecasted, but more importantly, what tens of millions of people per day. Every day we're adding a bunch of new ones. And quite frankly, it's even more than that, because that's just the people who trade. Everybody who else decides not to trade, their opinions are also embedded in the price. Because we think, I'm a non-trader, right? I think the price is just fine. Therefore, I'm not going to sell. If I have extra cash, I'm going to move it from zero risk, the cash, to the risk appropriate return for me. And so, but that's not a trading decision. That's a decision to collect the cost of capital for those securities.
So this is the 10th edition and 20th anniversary of index funds. This is the first time that you published with Ballast Books. What was the process like, writing, putting this together? As you said, this is not a standard 6x9 or 5.5 by 8.25 trim size. It's a full color interior with these beautiful paintings. Talk to us a little bit about the process of writing, publishing with Ballast, and how this is different than the previous 9 editions.
Sure. So when we started out, first of all, I wanted total control of what we put in the book. And if we went to the traditional publishing houses, that's not what I would have gotten. They were going to tell me what I could put in my book. And many of the concepts that we arrived at, and I arrived at, by the way, hardly any of this is my own creation. What I'm doing is I'm revisioning the academic research mostly by Nobel Prize winners. Okay. So I don't want people to think I read a few books and then came up with the Hebner investment strategy. There's Nobel Prizes for all of this.
Which is
Most
chapter
notably,
two.
that's chapter two, because the reason it's in there in step two, I don't want to forget your original question, but in the normal 12-step program, people are obsessed with their addiction, right? And what Bill W., the founder of Alcoholics Anonymous, came up with is people need a higher power than their addiction to help them sort of calm and to take over this mental desire to want to continue to engage in their addiction, whether it be drugs or gambling or alcohol. And so what he said was, find your God, whatever it might be. And so the religious aspect of Alcoholics Anonymous is pretty heavily embedded there, because people couldn't get over this sort of overwhelming, constant mind occupation with their addiction. What occurred to me in the investing world, so-called gods, in my opinion, are those who have dedicated so much of their life and their thinking and their learning activities to understand how markets work, and ultimately to earn a Nobel Prize for the thoughts that they have put down in an academic peer-reviewed paper. That is sort of the ultimate mentor for investors, the people that have gone to this incredible place in their careers to be able to earn Nobel Prizes. So what I didn't want is some editor who had not learned what I had learned to try to rewrite and to try to tell me what is acceptable in the book and what is not. So when I heard about you guys, you have a little different model in that regard. And what you did do is you brought a professional editing of the grammar of the text as opposed to the content of the text.
Line editing, proofreading, and you work closely with our Lauren Green, our director of author services, on the manuscript.
Exactly, which was very helpful, and which we hadn't really achieved doing this on our own. I actually never had a professional editor. I had multiple people working with me, some who were writers, but that wasn't their profession. And we refined the book over these previous 9 editions to a point, I think, which adequately told our story, but it really wasn't at a point that it was designed for what I'll call the mass market.
Right. And so did Lauren, how was that process with Lauren and the editing? I'm sure you didn't take all of her feedback. It's a collaborative process. It's back and forth. You know your content better than anybody. How was that editing process?
So I think more than anything, it was a little bit of an education for Lauren as to what some of these sentences were designed to say. And then she helped me rephrase them so that what they were trying to say was said in a little cleaner manner and consistent with Chicago style.
And how is the 10th edition different from the previous 9? How is, and it, more so than that, how is your philosophy, if at all, changed over the 25 years that you've been doing this? Markets changed, the world has changed so much in 25 years. How has the content of index funds and kind of how you operate changed in those 25 years?
Okay, so this is a very common question when looking at what we do. They say, don't give me 50 years worth of data. 50 years ago, the world was a completely different place, right?
Mm-hmm.
So the investing strategy should change with the world. Does it
Something
occur
tells
to
me
you?
you don't think it should change.
Does anything occur to you after our conversation why that might not be the case? Let me just restate it. The reason the changing world doesn't impact the cost of capital to the firms is because the risk of the world, the changing of the world, is priced in to the security. And so what has not changed is the ability of willing buyers and willing sellers through all of the world's stock exchanges to reprice the security to the new set of events that have occurred. So, from an investing perspective, nothing has changed. We have the exchange going on. They're just looking at different sets of information that gets priced in. So what has changed about the book is we have constantly updated the data from 25 years ago or 20 years ago. We've been in business 25 years, by the way. It took me 5 years to get that first edition out. And so what we're primarily doing is updating the numbers to the most current data we could put together to get it in the book. But also, there have been an evolving at the way that I have been able to explain this to people. So, for example, I wasn't talking about cost of capital as much in the early days as I have evolved. And what I've learned through talking to thousands and thousands of prospective investors and clients is I learned what's most effective in getting them to shake their head and go, and had to have their light bulbs come on and say, that, what you just said, finally helps me understand what you've been trying to tell me for all these years. And so this process of teaching makes me a better instructor.
Got it.
A better teacher.
You mentioned the audiobook before.
Yeah.
Why don't you tell everyone a little bit about some of the successes that we've had? This book launched yesterday. We have some bestseller lists and where they can go to get a copy of Index Funds if they want to buy a hardcover, ebook, audiobook.
Well, I was just looking this morning, and I was very pleased to see that the Kindle, of course, that's the lowest cost book, is number one in the new releases category and the mutual fund investing category. Mutual fund investing is probably the best category for this book. It's about index funds, which is a category of mutual funds. That includes ETFs today, by the way. And so we were number one in the Kindle edition. We were number two in the audio edition, and we were number 7 in the hard copy edition of the top 11 new release books in this category of mutual fund investing. So I'm thrilled with that. Of course, we did a little bit of a splash, and we told a lot of people at once, so that always helps in the rankings. But listen, I have a library of 2,500 mostly financial books. They're financial books in one way or the other. A lot of them are about statistics and math, all things that relate to the academic sort of approach to investing. And so I have a very good sense of what authors have attempted to write to educate investors since literally the 1500s. And not to break my own arm, but I have brought together what I learned from many, many authors. And I list, I think, 28 of my favorite books in the back of the book. But I have brought those all together and picked the best from them and then added my own one of my superpowers. You hear people ask, what's your superpower? One of my superpowers is the creative brain side that I have, works with the scientific side of my brain to bring these two together, which I think optimizes learning for the reader or the listener. And that is totally unique, and I think reached a new level of quality and a new level of learning that people can get from this book that has not been achieved literally by any other author. Now, I just broke my arm here, patting my own back, but I do
I
have.
say you for because there has been a lot of success around this book, and like we said, it's the 10th edition, 20th anniversary. I think you're coming close to perfecting it, perfecting the message, and for everyone out there, pick
Andy,
it up,
before you wrap up, I since you're wrapping up, I just want to throw one more thing in here. The
please.
fact that we're doing this podcast, which is these extended audio uh, experiences that more and more people are willing to listen to today, is a driver of the value of the audiobook. The audiobook could be thought of as this extended podcast where people go to learn today. My own son spends hours and hours listening to all these different podcasts. I said, Ian, what are you listening to? And he's got this long list. I'm going, what? How does this keep your attention, right? And so the fact that we're doing this, I think, bodes well for the idea and the investment to create a high quality audiobook for, I would say, a new generation of learners who go to these extended audio sources to get their new information.
Yeah, absolutely. Audiobooks are by far the fastest growing segment
Oh,
of
they
book
are.
consumption. Of book consumption, absolutely. It used to be,
Yeah, I know.
ebooks were skyrocketing; they've kind of plateaued. Audiobooks, have completely taken off. Podcasts as well, and so I think that while I asked the question about what has changed over the 25 years. So the core philosophy obviously has not changed, but you've still had to adapt with the times, with how you're communicating with potential new clients and how you're disseminating information. And I think this is a great example of that: the audiobook and the podcast. When you did your first book 20 years ago, there were no audiobooks.
No.
I don't, there were ebooks at that point. So I think you've adapted and grown very well with the times. Even if the philosophy, even if the investment philosophy remains the same, the content
Right.
remains the same. And that's the proof is in your success, both with the firm and with the book. So, Mark, it's been a pleasure working with you on index funds and continuing to work with you both in the production, the publishing, the marketing. Today on the podcast. Anything else that you want people to know? Tell them where they can reach out to you if they have questions about investing in index funds, they can get the book anywhere the books are sold.
Yep. They can also visit our website, ifa.com. That's India Frank Alpha or Index Fund Advisors.com. We've got a lot of content there, and it's up to date to the day, as opposed to the hard copy book obviously has a limit. And but the main thing I'd like to tell people is they work hard for their money, okay? And so you want to set up your money to work hard for you in when you get to a point in your life that people are no longer willing to pay for what we call your human capital, which is basically your time, right? We get to a point where we're 75, pick your retirement date. For me, I don't even know if I have one. I'm 71 now. But I love it, okay? And so and I really feel like I'm helping people. But you have a responsibility to everybody around you, your spouse, and yourself, to be your own fiduciary and to take care of your money in the best way possible. And you also have this responsibility to do this so that your children don't have to bear the burden of your financial requirements in your retirement if you haven't saved or invested properly. So, in some ways, we all have a duty to learn about investing so we don't just uh, find out in our later years that we have to lean on government or our family to take care of us.
Yeah.
So,
Well, I'd encourage everyone to go to ifa.com and pick up a copy of Index Funds everywhere the books are sold. Mark, thank you so much. I had a great time with you today.
Andy, it's been a pleasure.
All right. Take care.
Thank you.